I would like to thank you all for joining us for today's invited talk, which is part of Dev Connect Research Network's webinar series. We are happy to have our presenters today, two presentations, also two discussants. But before I introduce the presenters, I would like to remind you that this webinar is recorded, and to tell you that we will be happy to receive your submissions, your papers. If you are interested in presenting your paper in one of our webinars, please do not hesitate to submit it on our website. Also, if your paper is not ready yet, if you would like to have our assistance, we can also help. We can assist you with connecting you to experts in the field. So do not hesitate to check our website and use the same form to join our mentoring program. So for today, I would like to introduce Carlos Madeira from the Central Bank of Chile. Also Facundo Luna for Rutgers, correct me Facundo, Rutgers University. Also the discussants, whom I thank for trusting and also supporting the webinar. Jamel Saadaoui from the University of Paris 8 and Nabil from University of Paris Nanterre. So the first presentation will be led by Carlos Madeira. He will speak on, he will address the impact of information laws, impact on consumer credit access in Chile, particularly. The second presentation will also address the climate shocks, trade credit, and the firm resilience in Chile. The first presentation will last for almost 20 to 25 minutes and will be followed by a discussion and a Q&A session for 10 to 12 minutes, same for the second presentation. Thank you for posting your questions on the chat box or the Q&A box. We will try to collect them and address some or a selection of questions after each presentation. Thank you. The floor is yours, Carlos.
Thank you, Etienne. Well, I am very pleased to be presenting now at the DevConnect. I have been logged in a few times as part of the audience. So the topic that I will be presenting today is about the effects of information loss on consumer credit access. This is ongoing work, so it is still under development, and this will be sort of like an introductory analysis to the topic for which I plan to do more ambitious work in the future. I think it's a very important topic for both developing economies and for advanced economies in recent years. So we have across the world credit bureaus and credit registers. These are bureaus, data sets, in which it is compiled information on who repays their debts correctly and who fails to fulfill their debt commitments. Across the world, many people and many voters, specifically in Chile, they view such bureaus with a negative view. We know in terms of economics that these bureaus, they help lenders and debtors. They help lenders because they help to distinguish who is a risky borrower and who is a safe borrower. And they help the debtor because the debtor can show himself to the lenders and say, hey, I'm a good borrower. And therefore it makes easier for credit access. And there are lots of studies in economics journals showing that these bureaus increase credit access. But at the same time, many people view them as a sort of a blacklist. Like you did something Maybe it was 5 years in the past, maybe 10 years in the past. And it is something you wouldn't like people to know, but it is registered in the information of these bureaus. So a lot of people view this as making blacklists of people. And the governments have tried to adapt the regulations about what information can be published in these credit bureaus and how this information can be used. These questions will become more important now that we live in the information age, because across the world, both in advanced economies, but also in Africa, Latin America, you see companies like fintech companies are using information, and really a lot of information that used to be available on people 40 or 50 years ago, and now all of that is used to create borrower and debtor profiles. So now that we live in the information age, and it is across the world, these questions about what kind of information is useful and how this information should be used will become more and more important. The specific study that I'll be showing today is about a discussion of 3 different laws that restricted the information of the Credit Bureau in Chile between 2010 and 2012. Well, there is a lot of theoretical work and empirical analysis, but what the theoretical work and the empirical analysis shows in a conclusive way is that these credit bureaus provide a positive service. It's better to have information sharing, some information sharing, rather than having no information at all. So the credit bureaus are helpful for the debtors and the credit market. But a less conclusive question is how much information sharing. For instance, we could have information sharing of the last 5 years of someone's life, or the last 10 years, or the last 20 years. This was a question studied by Verkamen in 1995, but at least in the calibration of Verkamen 1995 and in Diamond, it appeared that more information was always better. The same for the works of Freya et al. It appeared that more information was always better. But recently, some works have started to challenge that, at least in the theoretical point of view, but there is still studies to be done in terms of the empirical results. So Chile, since in Chile, lots of congressmen, they view these regulations as blacklists, and they want to cater to voters that view these things negatively. Chile has been a lab for several laws that have taken information away from the credit bureau. So the first one that I will address here is the credit information of the unemployed in 2010. And sort of what it does is that it says, oh, being unemployed is tough. And therefore, it would be good if when you are in unemployment, in a tough situation, you wouldn't be punished by being added to a negative list. So what it says is that in the period in which you go into unemployment and are receiving unemployment insurance, any defaults or negative information is not added to the credit bureau, but it may be added to the credit bureau after you end the unemployment insurance if you haven't repaid your loans. In Chile, unemployment insurance lasts only a short time. It lasts 5 and 2 months, depending on whether you have a permanent or a short-term contract. And well, since 2015, this has been 5 and 3 months. The second law was slightly different. So the number of people and companies that are checking your credit report is considered to be a credit risk. Why? Because it could be a sign of a Ponzi scheme. For instance, if you are going to ask loans for many people, many banks, maybe you are going to engage into this scheme of paying one bank with one loan and going in a dangerous circle that may be hard to detect. This was a special concern for micro entrepreneurs in Chile. Maybe some of the young don't know about this, but 15 years ago, people used to do checks, right? People used to pay their rent in checks. They used to pay their business partners in checks. And these small businessmen or businesswomen, they would say, oh, every time they would pay with a check, someone would check their credit report, and then it would go affect negatively their credit score. And this was bad because in Chile, it's not just lenders that check your credit report. The schools check your credit report because they want to know if you will still be paying your children's academic studies 3 or 4 months ahead. And also the health insurance and the hospitals may also check your credit report if they are private institutions. So here, this law said that only variables that are clearly related to delinquency can be used for the credit score. However, the information of the checks still appears in the credit report, but it is a sort of a more expensive credit report. And then there was the 2012 law. The 2012 law was justified because in 2010, Chile experienced a mega earthquake. And then lots of people entered into the credit bureau for not paying loans. So people pressed Congress, and then Congress said that delinquencies below $5,000 would not have to be reported. Note that this is not a debt forgiveness. It's not a debt pardon. You still have to repay your debts. It's just that the debts are not reported in the credit bureau. This law was amazingly popular. In fact, it was a straight copy of a law that had been done 10 years before. And Congress, some deputies in Congress have asked to repeat this law several times since then. So it is a law that scared the lenders a lot because although it was only done in 2002 and 2012, people have asked for many repeats since then that were not necessarily approved. So maybe this sort of information is different across countries, but this is the information that is currently included in the Chilean Credit Bureau, the official credit bureau. But please note that many credit agency reports across the world now, they use an amazingly amount of information. I mean, I read that in Kenya, China, credit report companies, they check your Facebook, they check your LinkedIn, and they may even do analysis of your face to see, I don't know, if your face looks more worried, then you are more likely to be a stressed person that will default on your loans in the future. I mean, this is an amazingly updated topic because it's impressive how much real science fiction is being done in credit reports across the globe. So the Chilean Credit Bureau reports the credit scores over the last 12 months. It reports an ever clean indicator for the last 36 months and a history of the last 5 years of defaults, the number of unpaid loans and total amount. It also includes the default history of your spouse, because since you are legally obliged, and your spouse too, then it helps the information. Defaults are erased from history once settled or renegotiated. That was part of the consequence of this 2011 law. And then it also includes other information: gender, age, civil status, whether you are single, married, divorced, list of properties, vehicles, real estate. These ones can be pawned by lenders, or at least they can go to court. The tax value of your properties, your last 6 addresses, socioeconomic status, information on your private businesses and the private businesses of your business partners and their credit score. So although this seems like a lot of information, some we could dispute whether it is positive or not for the credit markets. Well, there are credit reports around the world containing a lot more in these days. So this is just to help see what could be the impact of the information loss. Elul and Gotardi, they published a paper in the American Economic Journal Macroeconomics, saying that information, it can be positive to delete information from the credit bureau if adverse selection is not so big and moral hazard is not so big. Because in that sense, if you delete negative information, it can help risk insurance, meaning you have this pool of people that are doing more positively and people that are doing worse, and it helps to risk insurance. But in order to be positive for welfare, these negative aspects cannot be too big. And also Elul and Gotardi posted that if you don't have so much negative information, then it's good for small businessmen, because your business fails and then you can have a positive restart. So this is how we can understand the information restriction laws. We could have 4 different groups that are good borrowers, borrowers with under 5 months of unemployment, long-term unemployed, and strategic defaulters. Before the 2010 law, we used to observe 1, and then 2, 3, and 4 were together, meaning we observed all negative adapters in the same group. But now what it does is that group number 2 is added to the good borrowers. So it shifts the information, not necessarily erasing it, but it shifts. And here would be for the 2011 and the 2012 laws. So here we would see a group 4+5. It would be the group with hard and soft inquiries into the credit report. And now this group, after the law, is summed to the group of good borrowers, meaning the number of inquiries that people have on you is no longer seen as a negative information. And after the 2012 law, we had these borrowers with median and low delinquency. These borrowers too were added to the group of good borrowers. So this is sort of like a theoretical framework that we could use. Now I'm going to study this with the Chilean Household Finance Survey. And I'm also going to use the National Employment Survey. And I'm going to match this survey data with data on banking loan records and data on unemployment insurance records. Unfortunately, I cannot have the triple match. I cannot match this one and this one exactly. So I have a paper with Facundo in which we say what we are doing is a statistical match between these two. And then I'm going to estimate models, which can be a linear model or a load sheet model, conditional on the observed risk factors like number of household members, age, education, and then there will be dummies for whether you are in a group that is affected by the law or not affected by the law. And I'm also going to include the information that is typically observed by the credit bureau, so that I can estimate this model with the information observed in the credit bureau and without the information observed in the credit bureau. So these are the groups affected by the law. One, they are only affected after the laws are passed. And for 2010, you are affected by the law depending on your unemployment risk. For the 2011 law, it depends on the checks or whether you have 3 or more loan applications. And this is the group affected by the law. And the 2012 law is whether you only have $5,000 or less of delinquent loans. So I'm approaching the end. So this is the variable for credit access, meaning a new loan, that's NL. This is the amount of new loans divided by the permanent income across a year. And these are the default at 1 month or more, or 3 months or more. And here is after the law of 2010, it increased credit access and it increased the size of the loans relative to your income. So it seems to have been positive in this. However, the law did not increase delinquency risk. So it seems to have been a positive law. The 2011 and the 2012 law, they decreased credit access. So the probability of having a loan decreased, But here we see that at least for the 2011 law, it had the positive aspect of increasing the size of the loan that borrowers were getting, and it decreased their delinquency risk. The 2012 law decreased the probability of getting a loan, and it also decreased the probability of delinquency. Well, I then combined this in a model, and I show the heterogeneous effects across the distribution. And I show, well, the 2010 law almost had no effect on the risk-adjusted interest rates, but the 2011 law reduced the risk-adjusted interest rates because it reduced delinquency risk. But the 2012 law had heterogeneous effects. It reduced the risk for a group, but it increased the risk for others a lot. So the 2012 law is sort of the more heterogeneous law because it creates some winners and many losers. So
Carlos,
that is...
I'm sorry for interrupting, but just to keep us on schedule, you still have 1 minute. Thank you.
Yeah, thank you, Etienne. So this is pretty much it. So my major conclusion is that these three laws help to show what Ellul and Guattardi and others speculate. So the 2010 law seems to be a law that affects a group that has little moral hazard. You are not going to go into unemployment just to benefit from the credit bureau law. So it has little moral hazard, but it helps risk insurance. It helps you exactly at this short period in life in which you need it. The 2012 law had a negative impact on credit access, mostly because it almost erased the credit bureau. It erased 2/3 of the credit bureau. So it's almost like having no bureau at all. And the 2011 law, it had little impact, but mostly positive because it helps this group of small entrepreneurs and businessmen. Thank you. So exactly on time.
Great. Thank you so much, Carlos. Thank you for the insightful and interesting presentation. I will leave the floor to Jamel for the discussion. Thank you.
Sure. First of all, thank you very much, Etienne, for the invitation. It's always a pleasure to listen Carlos discuss about his very interesting research, always different and always interesting. I have some comments, so I took some notes, so I will send you the comments later, Carlos. So feel free to not answer to everything. The first is, of course, implicit data work, very nice work. Carlos is very well known for that. But my question is more general in the sense that, is there something, you know, you have a too much finance literature. Is there something like too much information? Is this a real thing? Because if you think about it, you say, okay, if you have not too much adverse selection, if you have too much hazard, but in theory, if you increase the information, you will be able to detect if in a specific market, in a specific group of individuals, you can have proxy to have a more hazard and detect adverse selection. So this is a very general question. It does not, of course, obviate all the very, very good things in your research. But when I read that, I said, oh, wow, okay, that's interesting. But why we should not increase transparency to deletion is a kind of, for me, is a kind of a way of revealing hidden characteristic of consumers and borrowers, sorry. I mean, You have to delete, you have to forgive people because they made bad things in the past. They are not going to do that again. So you can also detect that by increasing the amount of information on them in a way. But yeah. So second question is, as the treated groups are somehow different between the different events, if you want to generalize that with different diff and so on, you have to find a way of reconstructing some similar groups. So I think this is something that you can, there is no direct way of doing it very easily, but I think something you can reconstruct by using not too much observations and making something but like a repeated treatment or something like that. I have also another comment about, of course, external validity. Is there a similar kind of regulation in other countries? That's very interesting. Does this depend on the culture of the country? This is a more political economy question. I'm a macroeconomist, but I'm slowly moving to political economy thing. Maybe in some countries, the effect would be greatly different. My best guess is that something like that could work in France, for example, but it could not work in Finland. You know, depending on the culture, it could also play, it could play in a different way, even from a theoretical point of view. So to finish and to not be too long, if you delete too much information, you will reduce welfare because some people, some borrowers are in the case of you know, this Ponzi scheme and then trying to cheat. But of course, if you are delete not enough, you will penalize some people who wanted to be good again, even if they have made a mistake in the past. So I think you are trying to find the good proportion of deletion from the information. And that is very interesting. I never saw that before, so I like the paper. So I hope some of my comments will help you to frame a bit the paper. Thank you.
Thank you so much, Jamel, for the interesting questions. We may take some questions from the floor, and then we'll let you, Carlos, answer some of them. So if you have any questions, do not hesitate to raise your hand and to take the floor. Okay, I have a question. So maybe I can ask my question, and if we still have time at the end, I can also ask the other one, and then you can address the two, mine and Jamel's questions and comments. I would like to know how transferable are your results, Carlos, to other countries, especially that what you've done. You've done it in a very particular context, which is the Chile's context. And also another question, which is the fact that the law 2010 and the other law did not give the same impact. So for policymakers, how should they think of the optimal level of information disclosure to balance financial inclusion and risk assessment?
Yes, so those are very good questions. So in terms of evaluating this for other countries, unfortunately, I cannot answer that, at least with the analysis done in this paper. It's completely specific, and even specific to Chile at that time. For instance, there is already a fintech company in Chile that uses more information. So maybe now it's even useless to regulate the Public Credit Bureau because there are already private companies publishing even more information out there. I do think, yes, like Jamel says, it sounds a bit paradoxical, and in the work Peter Diamond, he said it couldn't happen. Then Verkamen, he studied an empirical version of Diamond's paper, and in his calibrated model, he said it could happen, but in practice it seemed very implausible. It couldn't happen for standard values of the parameters. So only more recently has this question been analyzed recently. An example that is found that is some sort related to this paper is a law that was made in 2009 after the subprime crisis. So in this law in 2009, credit cards cannot change the interest rates too quickly. They must tell borrowers 60 days before they change the interest rates. And in a paper last year published in EconomiX, Scott Nelson, he showed this was good for the credit market. They had negative information if they could change interest rates in real time, but they couldn't change interest rates in real time. And because they couldn't change interest rates in real time, they had to wait for 60 days. This sort of increased risk insurance. So it is a bit like this. So it's a bit subtle. You have this negative information, but you cannot use it. And Scott Nelson found it was positive for welfare. I think maybe in the future, because I am planning to increase the analysis more, I may address some of the points that Jamel said. One problem is that you can see I only have 9,500 households. And this laws, they target very specific people, right? Small businessmen and unemployed. So it is a small fraction of the 9,500 households. And therefore it makes it difficult to find the comparison group that would allow for a very clean analysis. It's also difficult because the Congress made all these laws, one in each year. So, but I am trying to get data on the entire credit bureau now to see if I can get a clean analysis and maybe one that answers more questions. But yes, regarding the major question that you and Etienne had, I think it's very important. Perhaps it would require some macro modeling and then trying to see if with the macro model and then, I don't know, maybe some standard variables, unemployment is standard to observe. I don't know, maybe inequality could give a measure of how many people are poor. Maybe, I don't know, the fraction of people that have debts or delinquency that is available, right? We know the 30 and the 90-day delinquency rates across at least, I think, 50 countries. Maybe with some macro modeling, one could try to answer that question. Then one wouldn't rely on the micro data, but one would require, of course, on the ingenuity of the macroeconomic model. But it would be a question for the future. But of course, for Europe, now they have a sort of survey data of borrowers, right, which is coordinated by the European Central Bank. That could answer the question, at least for the Eurozone.
Thank you, Carlos. Maybe for the other question or the comments, we can discuss them at the end if we still have time. Let us move to the presentation of Facundo on climate shocks, trade credit, and firm resilience in Chile as well.
Hi, everybody. Thank you, team, for inviting me. I'm very glad to be here in the DevConnect webinar. I'm going to present now a chapter of my dissertation that is titled Climate Shock, Trade Credit, and Firm Resilience in Chile. Moving to the motivation, well, climate change poses economic risks. One of the risks is physical risk, and this comes from the fact that there is an increasing frequency and severity of climate shocks. And these climate shocks, if they become more frequent and severe, then can impose on economic losses that will be larger with the time. But these losses do not stay local. These propagate to the trading partner, to the import-output linkages. So in this context, I want to analyze what is the role for trade credit. Trade credit is the most important, one of the most used forms of short-term financing between firms. And the literature found that this can serve as a liquidity buffer, but also can amplify the shock depending on the situation. But the dynamic under the climate shock, like I want to focus on wildfires, are more than explored in the literature. Understanding this role can have can be important for the policy relevance. If we know what is the best strategy to address this, to affront these climate shocks, this can enhance the economic resilience, can improve the resilience for the import-output network, and then it can mitigate shock propagation in supply chain. So basically, the research question is very straightforward and focus on how the pre-shock trade credit position, I mean, ex-ante the shock, if the firm has more receivables or more payables, how this moderate or amplify the propagation of wildfire shock through the production network. Just a quick preview of the finding. The wildfires generate overall losses. This propagates to the trading partner, upstream or downstream, in both margins. But what is new or different from the literature is that the trade credit received of the firm has more generous payables, has more buffer to make the payments in the future. This acts as a liquidity insurance. This buffer the sale, the input purchase and deployment, and this buffering is stronger for smaller firms. Then we focus on the other side in the trade credit supply. This can amplify the losses and can defraud more the affected firm that issue more generous trade credit to the customers. Additionally, the indirect effects are larger than the indirect effects, so there is an evidence on the network multiplier or network amplifier. And one channel of this network can amplify this shock is through the financial friction. So if the firm is more liquidity constrained, this can have a larger impact on how this shock propagates through the network. Very quick about the literature. I would say that this paper contributes to three different strands of the literature. The first one is on trade credit and corporate equity, in trying to understand what are the reasons that the firms issue trade credit to trading partners or demand trade credit. And the second strand is about production network and how the shock travels through the production network, through the import-output linkages. Here we have the paper of Barrot and Sabagnat and Carvalho and co-authors that focus on natural disaster, but the other paper mostly focus on how the financial shock propagates through the import-output network. The third strand is how natural disaster affect the firm performance and the survival of the stability of the network. So my contribution here is that I try to bridge these three literature and provide new evidence that the trade credit operates as a state contingent instrument in the aftermath of natural disaster. It depends if the shock hit the supplier or the customer or is hit the firm directly. It will have different effect and different buffering. Additionally, I contributed to the methodology of the existing literature since I proposed to use a local projection different this framework instead of two-way fixed effect or event study. Since this can deal with the staggered implementation of this shock that occur very frequently, mostly every year and every summer, and to build some intuition on what will be the hypothesis or what will be the result that I can expect, I build a simple framework to generate some intuition about these shocks. just a preview what is the model of this simple framework. I propose use a focal firm that use contact light technology. This has a trading partner that is a supplier, an upstream supplier, and a downstream customer. And the firm can defer the payment of the input today by a share of fee that is how much of the input will be paid later. And I propose to use like a effective discount. If the larger is the term of the credit, of the trade credit, more will be discounted today from the firm. There is from the project constraint, I generate this liquidity constraint equation that binds with the shadow value of lambda. The multiplier is positive, so the firm has to finance the cash input. They have to pay today the proportion that is not financed by trade credit, have to pay the wage bill, and can incur in emergency procurement if one of the supplier is affected by a natural disaster. And they can finance this working capital using W, that is the liquidity wealth, and some external funding like banking loans. So from the further condition, I get that the key insight is that there is a liquidity weight marginal cost, where this from the purchase of inputs, where these inputs, the marginal cost of this input depend on how much is the share of the input that can be financed for the other firm, and also in the term. So the firm that is more constrained, that has a higher lambda, a higher shadow value of liquidity, will be more benefit if they have more proportion of the input that are financed by trade credit, and also if they have a higher term from their cash, so for the input purchases. So what this model will predict is that for 3 different types of shock, if the firm is directly affected, this has a different positions. The shock, like a wildfire, can destroy physical capacity, can destroy the productivity, affecting A in the contact light production, but also can impair the liquidity, reducing the liquidity wealth at W. So in this context, if the firm has more generous position of trade credit payables, then can relax this liquidity constraint, but cannot be able to restore the productive capacity. So the buffering here we expect that will be lower than in the indirect shocks, while in the upstream and the downstream shocks, we expect that it's more buffering, since this mostly impair the liquidity of the firm. Additionally, it can help to finance the emerging procurement if the supplier is affected. So if one supplier is affected and cannot deliver their input, then the firm can move to another supplier and have to pay higher price for this emergency input purchases. So additionally, this is focused mostly on the payables if the firm receives more trade credit, but if the firm issues more trade credit, then this can reduce the W, the liquidity well, and then can be more liquidity constrained and have a negative impact of the natural disaster in both margin in the direct and the indirect shocks. So what the model predicts is the firms that are more liquidity constrained are the most benefit from this trade credit. So I use as a liquidity constraint the size of the firm. So I predict that the smaller firms can be the one that benefit more from receive more trade credit. Moving to the data sources, I use a very unique data set that is the Chilean electronic invoice system. This is a metadata data that records all the transactions between formal firms that at the transaction level. So I have for each transaction the invoice or the value, the payment terms, what is the economic activity of both sides, the customer and the supplier, and the municipality or the location of the customer and supplier. And I match the data set with the tax returns to get a monthly level of the firm, and also with employer wage reports to get the wage bill of the firm. So this allows me to construct the full buyer-supplier network for formal firms in Chile. And then I can aggregate this at the monthly, firm month level to keep this data set more manageable. Then I match this data set with wildfire database from CONAF, that is the forestry authority in Chile. This record when the wildfires occur, the affected area, and where is the location of this wildfire. And I use as a treatment if there was a red alert declaration for wildfire. I additionally use as a robustness check if the wildfire is high, large enough using the burn area. But this allows me to focus on the wildfires that are severe, that are close to urban centers, and also are more likely to affect the firm, the disruption of the firms. The resulting sample is about 700,000 firms and more than 25 million observations at the Fairmont level. Following the trade credit literature, I exclude the financial firm, government firms, and utility. And I compute 3 different exposure margins. First, simplest one is the firm is located in a municipality that was declared a red alert. I treat this firm as a directly affected in that specific month. And then I compute 2 indirect measures. One is the upstream, that is the share of supply that are affected by that are located in red alert wildfire areas, and the downstream exposure is the share of the customers that are affected or are located in a red alert wildfire area. I use as the way the pre-shock share of using the previous year to avoid any kind of heterogeneity in my specification. Now moving to the identification strategy, I use a local prediction different diff. This allows me to trace the dynamic effect of the wildfires before and after the shock. I compute as the outcome long difference, focusing on using as a baseline the period previous to the wildfire. And the variable of interest is the exposure variable that can be direct, upstream, or downstream. I use a set of controls and a set of fixed effect to try to isolate as much as I can the causal effect of the wildfire. So I use a firm fixed effect and also sector, time, and month fixed effect, region, month fixed effect. Then to address the heterogeneity using the position of the firm regarding the pre-shock credit as a measure of liquidity, the liquidity constraint. I interact the exposure using a dummy indicating if the firm receive more generous trade credit or more generous payables, but also, on the other hand, if the firm issue more trade credit or more generous condition to the customers, using this as a dummy that consider both margin, the share that they demand or issue to the trading partner, and also the maturity or the term of the invoice to the trading partners. Then I use a clean control condition, that this control condition ensures that during the time window, that is a 6 months to before to 12 months after, all the control firms are not affected by any kind of wildfire shock. I use inverse probability weight to match the ex-ante characteristic between treat and control and reduce the bias on the selection. And then I use cluster the standard error at the municipality level, that is the treatment of the direct affected firm, and at the firm level for the one that when I measure in the indirect effect of the wildfire shocks. But as based on the results, I'm sorry, let me tell you that the first line is sales, the second one is employment, and the third one is the import purchases. So we can see that the 3 margin had negative effect on sales and employment, and also in import purchases. What is weird here, but I can rationalize in the paper and in the appendix, is that we see when there is an upstream shock or the supplier is affected, there is an increase in input purchases at the beginning of the period. But I can explain this as an emergency procurement because the firms that are affected here change from the traditional suppliers to new suppliers, and this can charge larger prices, and also all my variables are deflated, so I can try to rationalize this spike as emerging procurement. And additionally, there is no clear pretense, but only in this figure. So this helped to my causal identification of the shock, of the baseline shock of the local projection difference. Now moving on the interest part on how trade credit can mitigate this negative disruption, we can see that the baseline coefficient, the treatment coefficient in the three margins are negative from the real outcome, sales, input, purchase, and employment. And also, this increased the probability of exit of the firm. This implies that the firm will not be trading in the next period. But when we focus on the buffering, we want to see what is the effect of the firm has if it has more generous payables, how this interact or mitigate this negative effect. And we can see that for the direct exposure, the effect is the buffering is barely significant, is consistent with the prediction of the model. But for both margin, the downstream and the upstream is significant, is economic and statistically significant, and reduce sales, the negative effect of sales and purchases, and also reduce the probability of exiting other firm. So in this case, I would say that the credit received or the payable account are state contagion liquidity insurance, that this buffering or this state contingency depend of where the shock is to the trade pattern of the firms. Now focus on the other side. If the firm issue more trade credit or more generous trade credit to the customers, there is no evidence. All the baseline coefficients are negative, but the interaction are mostly not significant, so there's no real result here. But in the case of the downstream exposure, when the firm is exposed to the customer shock, this increases the probability of exit. So if the firm issue more trade credit to the customer cannot repay their debt, this can distress the firm, the focal firm by itself, and this can drain the liquidity and then have this negative effect on the exit probability. In the other margins, I don't see this vulnerability. So there is asymmetry regarding what is the position of the firm. If the firm has more trade credit than they issue, it's an insurance, but if they issue more trade credit to the customer, it's more vulnerable to the climate shock from the downstream suppliers. The customer, sorry. And then using the size of the firm to validate the mechanism of the liquidity constraint, I saw that the smaller firms are the ones that are most constrained, are the ones that benefit more of having more generous conditions from their suppliers. Since this can mitigate all the real margins. For the medium-sized firms, also they have a milder buffering, but also it's still present. But for the large firms, there is basically no difference in having more or less trade credit than the other large firms. So this is implying that since the large firm can have an external source of funding, this cannot benefit as the other firms, as the more firm from trade credit. Additionally, this helped me to roll out any unobserved firm quality. For example, if the ex-ante the firm that receive more trade credit have more or better managerial capacity or better firms have unobserved quality, then I should expect to see some kind of this behavior in the large group, but I don't see that. So this can help with my identification strategy. Now, moving to the aggregate implication, if I compute a simple back of the envelope calculation, computing the average effect of the average wildfire, found that there is a output loss of 0.075%. That 2/3 of these losses come from the indirect channels. So the network multiplier will be around 3. That is comparable with the other multiplier found in the literature. Is between the paper from Carvalho from earthquake and from Roton Sabañat used several natural disasters in the US. And if I do a simple contrafactual, assuming that all the firms has slack payables, then this aggregate loss fall about almost 2/3 again. So a conclusion here will be that the most aggregate cost come from the financial friction in the network, and 1/3 of these negative losses come from the physical destruction. So it do matter what is the liquidity of the firm at the time of the shock, and this can mitigate how the shock propagate or travel through the network. Just as a conclusion, I would say that the wildfire generate persistent up to 12 months after the event, real losses in trade margin, in sales, in input purchase and employment. And the payable or more general condition, more liquidity the firm has, this can have act as a continued liquidity. But if they supply more to the customer, this can amplify the vulnerability to these climate shocks. There is a network multiplier of 3, and as just a few policy implications, in the aftermath of the disaster, the public program or the support program should focus not only in the directly affected area, but also should go to try to help the trading partner of the affected firms. Chile has this instrument to do this because with the electronic invoice target can see if the firm has trade partners that are affected indirectly for this shock. Additionally, the liquidity program should be focused only in small and medium-sized firms. And to reduce the vulnerability of trade credit supply, should be they can implement program to help firms to monetize the receivables through factoring or another channel. So this can mitigate this amplification of the trade credit receivable. In some limitation, I am not moderating the dynamic of the trade credit. I treat this term as predetermined before the shock. And also I focus on the intensive margin. If I focus on the extensive margin, it will be a huge, large data set. I cannot the computational power to do that. But additionally, maybe this lack of vulnerability for other economies, but I think that for Latin America's economy, this will be an important result and will be validated since they have similar institutional context. So as the key message, I would say that the distribution of the interfinancial position of the firm can determine what is the aggregate impact and can determine the resilience of the production level. Thank you.
Thank you, Facundo. Very interesting, very clear presentation. I will leave the floor to Nabil for the discussion, for the comments, and then we'll take some questions from the floor. Thank you.
Okay, so thank you, Facundo, for this interesting and ambitious paper that raises a very timely research question. So allow me to start with my remarks and questions. So starting with, I would like to raise first a semantical point regarding the definition of the shock. You talk a lot about climate shocks, but focus only on wildfires. So as we know, wildfires are not strictly climate shocks, but rather they are climate-related shocks whose occurrence depends on a combination of climatic conditions, local factors, and human activity. So these distinctions may matter, especially if the paper aims to speak to a broader literature on climate risk. And related to this previous point, there are no stylized facts on wildfire in Chile in the paper. So as a reader, we would like to see their frequency over time, the geographic distribution, to assess whether the country, the Chile, is prone to this specific natural disaster or not. And so this also raises another question: what is their economic and macroeconomic relevance relative to other disasters in Chile, and why focusing specifically on wildfires rather than on other climate-related events such as floods, which are often more directly destructive to capital and infrastructure? So I think that you need to clarify this choice to strengthen the validity of the result. And now regarding the theoretical framework you develop in the paper, the model abstracts from default risk So the risk that focal firms default on the reimbursement of the trade credit, which seems restrictive in a context where trade credit is central. It can be also directly linked to the probability of exit, which is not discussed in the theoretical section. And more fundamentally, the mechanism you present in the theoretical framework through which trade credit operates is not fully intuitive. In particular, I think that the model suggests that higher ex-ante trade credit allows firms to increase emergency outlays, but it's not clear. No, actually, you model the trade credit decision as an exogenous ad hoc parameter. However, it's unclear what defines this decision parameter. And here a natural question emerges: why do firms would accumulate trade credit ex ante, and why would it increase emergency outlays? What's the mechanism here? Is it because they anticipate the shock? And if they anticipate the shock, does that mean that they take the money from the credit, they don't use it, they only put it in an emergency outlay? And here I can suggest that so they don't use the money. And actually, and what is the incentive of the firms to get the loan and the trade credit in the first place if it's not to anticipate the shock? So here, a possible extension that I can propose is maybe to model the shock risk explicitly as a stochastic process, so that the firms chose trade credit ex ante under uncertainty or climate shock uncertainty rather than taking it as given. Regarding the empirical results, so I have a remark on the red IRFs you have in the paper, but you didn't show it in the PowerPoint in the presentation, so I will pass on it. The second remark on the empirical result is I was a little bit surprised by how tight your confidence intervals are. So this could reflect maybe the large sample size, but it also might suggest that the presence of a network dependence or serial correlation. So maybe you need to test that. And I think that it would be helpful to better understand and better show in the paper how the inference is handled and whether alternative clustering or bootstrap methods would have yield similar result, or I don't know, but you need to check this point, I think. A third question or remark in the empirical result is the interpretation of the upstream shocks. So this means that an upstream shock relies on the idea that firms can switch to alternative suppliers when the supplier faces a shock, albeit at the higher cost. But we may think that this assumption may be a little bit strong, as supplier substitution is often subject to substantial friction. I don't know, I think maybe of cost, search cost, input specificity, and contractual constraint. So how do you address this question, and whether you thought about it or not in the paper? And finally, my last advice would be maybe it's an additional exercise mainly that intend to isolate one of the most severe wildfire episode in Chile and run a standard event study to see whether your results are robust or no. Especially, so I think that this could provide a more transparent validation of the findings, given that the difference with different times of treatment remains somewhat controversial in the literature. So that's it.
Thank you, Nabil.
I think, that's it.
Thank you, Nabil, for the very constructive remarks. I will ask maybe Facundo to address these comments in 2 minutes, 2 to 3 minutes maximum. I may add a question from the chat box. How do you think reducing VAT while increasing income tax, personal and or corporate, would change results? And the last question, my question is, I'm just curious about how sensitive are your results to the structure of the network, because you found that indirect effects through productive networks are larger than the direct effect. So how sensitive are your results to the structure of the network? Did you account for this? Please go ahead.
Okay, thank you, Nabil, for the comment. Very, very useful, the comments. There are some things that I already think about. For example, when you talk about the geographic distribution or the stylized fact from the wildfires, in the last version of the paper I added, I think I sent you an older version. I put a graphical a figure of the distribution of wildfire and the burning intensity area. So I addressed that comment, and thank you for noting that. Regarding why focus on wildfire, is just for the data availability. So far, I'm just trying to collect another source of shocks like drought that is very important for Chile as an agricultural country. And also I cannot float, but so far I don't have access to the data. I'm trying to work expand this paper on that. So thanks for the comment. Then for the theoretical part, is just I want to focus that I can improve significantly the paper, improving this theoretical part, but my focus is in the empirical one and just use the theoretical as a tool to build some intuition. I can add some of the text that you mentioned. I think it will improve substantially the paper, so I thank for that. Then for the afternoon shock, regarding how I assess if they change the supplier, I just did a simple exercise in the appendix that how they change the number of new suppliers after the wildfire, and I saw that this that the firms that are affected by the afternoon supply has more new suppliers after the shock. So I tried to rationalize the upstream exposure of the emerging procurement doing this exercise in the appendix. Maybe it's not enough. I had to do something like separate the price and quantity. I can do that in the data, but it's much work. But it's something I have in mind. So thanks again for that. I think I briefly answered your question, Nabil. Then regarding the question on the chat, I have to think more about that. I haven't think about that, so I'm sorry. And Etienne, your question about the
structure of the network.
Yeah, I take the structure as a given. I didn't have any modeling of the structure, so what I see in the literature is that usually the direct effects are lower than the indirect effects. So this is consistent with this in the paper, like in Barot and Sabagnat. So I am not concerned about the structure of the networks. It's just what's given by the data. I didn't anything additional to model these links between firms. Yeah.
Thank you, Facundo. Thank you for all your contributions. I would like to thank you on behalf of my co-founder, my colleagues, co-founders, Eliane Al-Badawi, Stefania Lovo, Omar Sen, Shahir. Your efforts are amazing. So you are most welcome in our webinars. And I would like to announce the next webinar, April webinar, which will be it will be hosted on April 21, featuring Gwen Jiro Clochard, University of Osaka, and Anshika Mathur from Shiv Nadar Institution of Eminence, India. They will speak on mobile data predictions and connectivity and crime in different countries. So we hope to see you there. Thank you so much.
Sure. Thank you.
Thank you very much.
Thank you very much.
Thank you, everybody.
Good work, everyone.
Bye.
Thank you.
See you.